Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host, along with Brian London. We have an amazing guest today, a repeat guest, and also a long-time speaker at the New Orleans Investment Conference. He is Peter Schiff, an economist, broker, author, and host of his own show, the Peter Schiff Show podcast. His organizations are 𝗀𝗶𝘁𝗃𝗀𝗍, where he's the chief economist and global strategist, and 𝗀𝗵𝗄𝗿, 𝗀𝗵𝗄𝗿.com, 𝗀𝗵𝗄𝗃.com. Peter, welcome in these historic times.
Well, thanks for welcoming me on. And, I'm doing this interview where I've been doing a lot of interviews recently, just from my house.
Peter, I've been listening to your own podcast, and the chief theme, I mean, I should note that you were the author of The Real Crash, How to Save Yourself and Your Country. That was in 2014. And just before we started the show, you were mentioning that you foresee the decline or devaluation of the dollar as a key signal that the crash has arrived, the one that you've foreseen. But my interest is in this new normal. What is going to be the permanent or lasting impact of this pandemic?
Well, I mean, maybe the pandemic was the final straw, to break the camel's back, or the ultimate pin for the bubble. But I think we're going to get the real crash, and this what's happening now is not the real crash, because the dollar is still holding up, right? So we're printing all this money and sending it out to people, and the purchasing power hasn't collapsed. And so this is actually emboldening the politicians. Hey, if we could just print money, if nobody actually has to go to work, nobody has to produce anything or provide any services, we just print up money and mail it out to everybody. I mean, this is great news.
Yeah.
I mean, so as long as the Fed can keep printing and the world will keep taking our paper, then, we can go along. But the crash is going to happen when the bottom finally drops out of the dollar. And then we start to see a big increase in consumer prices and long-term interest rates, despite the Fed's attempts to suppress them. Once inflation really starts to take hold in a big, big way, which is going to happen a lot quicker than people think. In fact, once it starts going, it's going to just snowball. But that's when we have a real crash, because that's a crash the Federal Reserve can't do anything about. That's a crash that the government can't bail us out from, because sure, they can keep sending us money, but if the money that they're sending us doesn't buy anything, well, then they haven't accomplished anything. And that's what's coming. And when that does happen, then you're going to see the price of gold really moving up. I mean, now it's moving up, but I mean, it's slow. I mean, it's making new highs in euros or Aussie dollars, or, but in terms of US dollars, we're not even back up to where we were in 2011. And we printed a lot of money since then, and we're printing up faster right now than we've ever printed.
Peter, a lot of what you're saying is, of course, familiar, because you've been saying it for a while, and you said it for the last crash as well. And you've been predicting, and of course, we've had a lot of conversations, you and I personally, on whether this next crash is going to be the big one, or whether we're going to have another cycle or two after that. What's amazed me about what we're seeing now is that I know you predicted it. I've been predicting that we were going to see such massive stimulus programs, more QE than ever before, zeroed interest rates, et cetera, et cetera. I was predicting, at least, that it was going to happen over the next 3 to 5 years, and the precipitating factor was going to be something. We didn't know what it was, but they were going to make up some excuse. And now what we've seen is that COVID has become the excuse. It's a good excuse, but it's become the excuse. But everything, at least that I was predicting, would happen over the next 3 to 5 years, it happened over 3 to 5 days. So this rapidity of this, this surge and the way everything's developed so quickly, it's been absolutely awe-inspiring. And I'm wondering if that has changed your outlook, your views that you've been talking about for so long about the next crash and the dollar and all of these things coming to a head. If the amazing speed
of
it
hasn't really changed anything, because
Oh, we've locked up. We lost the last 5.
No, it hasn't really changed anything. Do you want to continue there, Peter?
Yeah. Okay. No, I mean, the crash has been long overdue anyway. I'm getting an unstable internet connection, I think is what it's telling me. But so I do think that the coronavirus has now accelerated a process that should have accelerated on its own a long time ago. And while my economic forecasts never really included a pandemic, I mean, to me, the pin is not what matters. It's the bubble. And everybody is losing sight of the bubble because they're focusing on the pin. And yeah, you're right. Everybody is now using this as a catch-all. Companies that would have gone bankrupt anyway are now blaming it on the virus. I mean, you have municipalities and state governments that were bankrupt, are now saying we need to be bailed out because of the coronavirus. So kind of everybody gets a pass now and everybody gets free money because this was nobody's fault. But what was everybody's fault is the lack of preparation for any problem. The fact that we have no savings as a society, the fact that corporations were levered up to the hilt, that they spent years and years using their cash to buy back their own overpriced stock, and they had massive debt, that governments all went into debt, making promises that they couldn't keep, underfunded pensions, and all sorts of other mistakes that were made. The fact that individuals have been living paycheck to paycheck. They've maxed out their credit cards, their auto loans. They got all these student loans. They got mortgages. The fact that we're all living in this debt bubble, whose fault is that? I mean, obviously, it takes two to tango. So a lot of the fault lies with the borrower, but the borrower was enticed into making these bad decisions by the U.S. government, by the Federal Reserve, that artificially suppressed interest rates for years and years to enable the debt bubble to get bigger. Whereas had the Fed done the right thing and allowed the debt bubble to pop and more bankruptcies and more foreclosures and allowed a real restructuring, we would have actually had a healthy economy that wouldn't be so sick right now from the coronavirus. Because if people had savings, they could go without a paycheck for a few months. Businesses could furlough their workers who could afford to pay the rent and put food on their table. And the businesses could ride it out. It's only because of the leverage position that we're in. That's why I said from the beginning, this is a financial crisis because of the debt. I mean, the real estate crisis became a financial crisis because of bad real estate loans. Well, now all the loans are going bad. Everybody is needing a bailout from this. So this is much bigger. And I always said from the beginning, from the minute the Fed announced that they were going to try to taper QE and that they were going to normalize rates to shrink their balance sheet, I always said that was impossible, that the Fed could never do what they pretending they're going to do and what the markets expect. I knew that at some point they would have to go back to QE and go back to zero. And by the way, this started not long before, but months and months before the coronavirus, because the Fed cut rates 3 times in 2019. The Fed went back to quantitative easing in 2019. The coronavirus didn't even start until 2020. So they already proved they couldn't do what they were claiming they were going to do. And they already proved me right. But the reason I knew that QE4 would have to be bigger than QE1, 2, and 3 combined, which it already is, and it's massively bigger. But I knew that because I knew that the bubble that the Fed inflated after 2008 to replace the one they inflated before 2008 was much, much bigger. And when you have an economy that's based on serial bubble blowing, the next bubble always has to be bigger than the one that just popped. And so I knew that in order to try to make a bigger bubble than that one, which was a massive bubble, it would have to throw everything it got. It would have to take such an enormous amount of stimulus. But I always said that it would be too much, that we would actually get the overdose that we should have got last time, but we were able to get away with it. And that's actually created a false sense of complacency. People think because we printed so much money after the 2008 crisis, and seemingly there was no consequence, right? The markets made new highs and we didn't have all this inflation that guys like Peter Schiff were warning about. So now everybody thinks we could do it again. And like, oh, we took the balance sheet up to $4.5 trillion. Now we could take it to 10 trillion or 20 trillion. Hey, there was nothing wrong with the national debt of 20 trillion. So why not 40 trillion? Why not 50 trillion? I mean, even the Republicans now are like, yeah, I mean, just keep on printing. We want to bail everybody out. You know, doesn't matter. Let's cut taxes and increase spending. And you know, it's at perfect time now. Nobody expects anything to go wrong because they got lulled into this false sense of complacency. But this thing is going to implode very, very quickly once it starts to happen.
Peter, a lot to unpack there as usual, and you're preaching to the choir. And this is kind of stuff I've been saying, and you know what I've been writing in Gold Newsletter and the like for a while. Of course, you say it so well. You mentioned the debt. You know, when Trump was elected, I mentioned that according to the pattern under Trump, if he lasts 8 years, the national debt will double, and so it'll go to 40 trillion. I said, sounds crazy now, but that's the pattern, and it doesn't sound so crazy anymore. And in talking about the debt, there are theories out there, prominently Brent Johnson's theory, the milkshake theory about the dollar, and part of which is that there's so much dollar-denominated debt out there that there is potentially a shortage of dollars to fulfill that great demand, and that the dollar will soar, at least initially in this crisis. What are your feelings on that?
Well, I disagree with that. I mean, first of all, the dollar isn't soaring now. So why isn't it? I mean, it's up, but it's not soaring. I mean, the dollar index isn't even above the highs that it made, a year or two ago. So where is this big dollar rally? I mean, in 2008, we got a big dollar rally. We're not getting one now. And I just don't buy the idea that there's going to be a shortage of dollars. I mean, there's so many dollars out there. I mean, we're just flooding the world with dollars. And in fact, look at oil prices. I mean, oil prices have collapsed. One of the main reasons that you need dollars is to buy oil. Well, I mean, oil is so much cheaper now, and you don't even need as much of it. We're not using as much oil. So clearly the demand for dollars to buy oil has come way down. But we are flooding the world with dollars. And in fact, if it wasn't for the Federal Reserve, I think we'd already be seeing a big rise in interest rates because nobody wants to buy dollar-denominated debt. I mean, so it's the Federal Reserve that's buying it all. So I know in the short run, there is some liquidity problems. Maybe some companies that are having trouble with their dollar debts need to get dollars. But I think that's just a very, very short-term phenomenon. I think ultimately, once the dollar starts to collapse, nobody is going to be worried about their dollar debts. The people who are going to be worried are the people who are owed dollars, who are being repaid with money that has no value. So I'm not concerned about all this dollar debt from the point of view of the borrower. I'm concerned about the lender. I'm concerned about who owns all that debt, the fact that it's going to have no value. And when people talk about debtors and they try to say, well, who's the biggest debtor? It's the U.S. The U.S. has the most debt. We've got the most dollar-denominated debt out there. It's America, not the emerging markets. I mean, they've got dollar debt, but we're the big debtors, and we run huge trade deficits as well as budget deficits. So we have these twin deficits that need to be financed. And who's going to finance them? Nobody. I mean, we can't afford to pay anybody a decent amount of interest because the sheer volume of the debt is so big. We couldn't service. It started to break. The national debt was 23 trillion or 22 trillion, and they had to call off quantitative tightening and go back to quantitative easing. It was because the markets, the short-term markets were collapsing, and there wasn't enough demand. So the repo market was pushing up short-term rates, and the Fed panicked and just went back to QE, even though they didn't want to call it QE, because the market was trying to raise rates, and the Fed knew that we couldn't afford to pay because there was too much debt for a market rate of interest to be sustainable. And so they already suppressed it. But now we are adding debt like crazy. The national debt now is skyrocketing. I mean, the Fed's balance sheet is like 6.3 trillion as of last week. And, the national debt blew through 24 trillion, right? We're headed up to 25 trillion. I mean, Bush is going to add more debt in his first term, assuming he doesn't have a second term, but he will add more debt during his first term than Bush added in 8 years, his entire 8 years. And you're right. If Trump manages to get reelected, which I doubt, but if he does, he will double the debt again. just like Obama doubled the debt, just like Bush doubled the debt. But the question is, can we do it again? Can we go from 20 trillion to 40 trillion without a debt crisis and a sovereign debt crisis? And what people are also missing, when you look at the debt to GDP, GDP is actually contracting now. I mean, it's contracting at a rate that it hasn't contracted since the Great Depression, if not even faster. So as our GDP is going down and our debt is exploding. So what does that do to debt to GDP? You're shrinking the denominator and your numerator is skyrocketing. So we could be at 150, 200% debt to GDP by next year.
Explore, discover, develop. The Gold Newsletter podcast is proudly sponsored by the Discovery Group, an alliance of public companies focused on the advancement of mineral exploration projects with a proven track record of generating exceptional shareholder value through responsible, sustainable, and innovative development. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
Hello, listeners. I am Daniel Duarte, and this is our weekly segment with the Discovery Group, the proud sponsor of the Gold Newsletter podcast. Each episode, we get to know more about a company within the group. And today, I'm so pleased to have Claudia Tornquist with me again. She is president and CEO of Kodiak Copper, formerly known as Dunedin Ventures. The company has a portfolio of 100% owned copper porphyry projects in Canada and the United States. Claudia, welcome back to the show.
Great to be here. Thanks for having me, Daniel.
So the name change of the company is done. You are now officially Kodiak Copper. Why don't you refresh our memory about this transition? And please tell potential investors where your shares are trading and the new ticker symbol.
Yes. So we've changed our name recently to Kodiak Copper Corp. And that name change really marked the last step in our transition to a copper gold porphyry exploration company. So we're 100% focused on copper gold porphyry going forward. And Kodiak Copper trades on the TSX Venture, now on the symbol KDK. And maybe just a quick sort of background what our name is about. The Kodiak is a bear species, as many of your readers will, I'm sure, know. And we picked that name in honor of our founder and chairman, Chris Taylor, who's obviously well known as the CEO of our sister company, Great Bear, which is one of the great exploration successes in the last 2 years in Canada. And to honor that success, that's really why we chose a bear-related name, and hence Kodiak Copper.
Interesting. You have been very fortunate in advancing your projects. Kodiak is going to kick off its 2020 exploration program with a geophysical survey, according to a recent company announcement. Is that right?
That's correct. We are just about to start a geophysical survey at our MPD copper gold porphyry project in southern BC. We are very, very fortunate in that we are not impacted by any virus-related lockdowns, and we can safely explore this project. We announced a discovery earlier this year at MPD, a great drill intercept, and are now very excited to gear up for the follow-up drill program. And in preparation, we are now flying a geophysical survey that will give us then more information to better be able to target the next set of drill holes. And that should be a very exciting program. It will be a bigger follow-up program, and we'll have better information. So I think we have a very good kick at the can to generate some exciting results there.
And that is a fully funded project, right? You are doing this on the back of a private placement that you closed last month.
We were able to close a private placement in mid-March. I'm very grateful to our investors who have shown us confidence and enabled us to close that placement in very difficult market conditions. That means we are fully funded and are able to progress our work as planned, which puts us obviously in a good position to be then ready with good results as and when the equity markets recover.
Perfect. And of course, we can't avoid talking about the elephant in the room, which is COVID-19. How are you handling this situation, and what is Kodiak management doing to keep advancing your project safely?
We are in a good position in that our NPD project is very accessible. It's a project in southern BC, right in a producing copper belt with all infrastructure, all services nearby. So we are not camp-based or anything like that. We can staff the project and the work locally, and that will enable us to move forward safely and with all the social distancing protocols obviously in place that are required to do this work safely.
Well, we hope the situation will improve soon. Claudia, thank you so much for your time today and for updating us on Kodiak Copper and its opportunities.
Thank you, Daniel.
Yeah, and that's one of the areas that I've been focusing on as well for a long time, is the debt and the implications thereof. And all of this, all the calculations and analyses that I did were at much lower debt levels, much higher GDP growth levels, and everything's just so out of whack right now. The implication of all of this, as you mentioned, as you touched on, is that we can't have real interest rates. My thesis has been that we can't have positive interest rates, and that you have to have monetary inflation that exceeds the rate of interest you're paying on the debt, or it crashes the budget. So you have to have negative real rates going forward. And that's just incredibly bullish for precious metals. Not only negative rates bullish for precious metals, but if the markets look forward and they say, well, hell, there's no way we can ever have positive real rates again, then the market's going to look forward and price that into precious metals.
That's the key point that I've been making for years, because what saved the dollar last time, the reason that gold stopped going up in 2011 when it hit 1900, what started that bear market, right, was the widely held belief that not only was the Fed's policy a success, the 0% interest rates and the QE, but that it worked so well that the Fed could end it, that it was an emergency measure, and that they were going to normalize interest rates and shrink their balance sheet. And so it was the anticipation of normal rates in the future and a lower balance sheet that powered the dollar and pushed down the price of gold. Well, once people finally conclude what they should have known from the beginning, which was obvious to me, was that once you induce all the debt, like once you encourage society to take on more debt, you can't pull the rug out from under them by raising rates, because everybody has so much debt that the minute you try to raise rates, the whole thing implodes. It's like I was saying, you can't get everybody high on drugs and then take away the drugs and expect everybody to be high. You need the drugs to stay high. So the cheap money needs to be there when you have all this debt. And so when the world realizes that interest rates are down forever, that the balance sheet is going to grow in perpetuity, that there is no shrinking, that we are effectively monetizing the debt, that we are operating monetary policy like a banana republic, and that even if inflation picks up in the future, that the Federal Reserve is powerless to do anything to slow it down, that inflation will just get worse and worse and worse. And so once people realize that, then nobody is going to want to own dollar-denominated debt, any dollar-denominated debt. And so then the Fed is the only buyer. They've already started. I mean, they're buying muni bonds, they're buying corporate bonds, they're buying junk bonds, they're buying collateralized obligations with credit cards and auto loans. I mean, they're already buying the crap now. But wait till the dollar really starts to fall, and nobody wants to ride that down. And then it's a hot potato. You know, everybody wants to get rid of the dollar. Nobody will hold on to it. And then, you know, the question is, once inflation really starts to get up there, I mean, 5%, 10%, 15, whatever it's going to go officially based on their rigged CPI. But will the Federal Reserve ever try to stop it? I mean, will they say, okay, we got to let interest rates go up to 20% or 30%? Are they ever going to do that and force all the defaults? Or are they going to just print the money until it's completely worthless? I mean, but those are our only choices. But there's no good choice. There's just a less horrible choice.
There really isn't. And you're right. The Fed has created, I mean, their whole goal was to create this wealth effect. And they were very successful. We didn't have retail price inflation the last time around. They ended up in the financial markets and they blew up those bubbles. But they created this monster, and now they have to keep feeding it, because if the stock market goes down, the economy goes down, because so much of it is based on that now. But as far as gold, why gold in the last instance of all this massive QE and everything, my view on that is gold peaked when almost simultaneously with the Fed announcing QE3, which was unlimited quantitative easing. We're going to do it as long as it takes until it stops, until it works. Gold pretty much peaked then. And my view on that was because the speculators who were setting the paper gold price looked at it and said, well, the next announcement is going to be, oh, we're ending QE. So buy the rumor, sell the news, and they stopped buying it and they started selling it. Plus the fact that we weren't seeing the retail price inflation everybody was looking for. And of course, that's because it all ended up in the financial markets. My view in this crisis, in this episode, is that we're going to have to see some retail price inflation to maintain upward momentum. We're going to have to see real world effects of this monetary inflation this time around.
There's no question, Brian, that we're going to see that. Because
I do think that's going to happen.
I mean, we still have the lag from all the money that they created that went into the financial markets. That's still going to go into the real economy. It wasn't there permanently. It was kind of there temporarily. But that money is going to move into the real economy. But the other element of this particular crisis with the coronavirus is that a lot of people who used to be working are not working right now. And so we're not getting the productivity associated with those workers. Either they're not producing as much goods, or they're not providing as many services. So the supply of goods and services is down. At the same time, everybody is printing money. And people are focused on the fact that, well, oil prices are down. Yeah, because nobody's buying any oil. That's why oil prices are down. But if you look at the prices of the things that people are actually buying, they're going up. Food prices are going up. And a lot of this stuff is going to be in short supply. Medical equipment, pharmaceutical, all this kind of stuff that people are buying is going up in price. And so prices are going to be going up. And they're going to be going up more and more rapidly as we get further into the future and start running into these supply shortages and bottlenecks, and all the supply chains are broken down. And then, of course, once all the airlines mothball all their planes, the price to fly is going to go up. I mean, there's not going to be that many planes in the air, but if you want to get a ticket on one, it's going to cost a lot of money because there's not going to be a lot of flights to choose from. And the same thing's going to happen with oil. Look, right now, today, oil prices are below $10 a barrel, because we're producing all this oil that nobody wants, and we can't even afford to store it because all the storage facilities are full. So we got no place to put this oil. But what happens after all of the U.S. oil companies go bankrupt? All these shale producers and all these companies, they're all going bankrupt. So they're not going to produce any oil in the future when people actually want it, right? There's a lot of oil now that nobody wants. But in the future, when people need oil, we ain't going to be producing it. The prices are going to go up.
Yeah, the CPI is going to adjust, and everybody's going downward, and everybody's going to ignore it because it happened because of the shock in oil, and there's people staying at home, et cetera. But when we do get past this and the economy starts to heat up again, the oil price is very likely going to, even if it gets to $30, it's going to more than double. And that's going to have a profound impact on reported CPI, et cetera, et cetera. So you're right. We're having supply disruption, and then when we have demand coming back into the market, those suppliers are not going to be there. It works across the whole commodity spectrum as well.
Yeah. People are overlooking that, or they're looking at all the travel related things where, the prices are down. But prices are going to go up. And it's amazing to me that people are just thinking that this is deflationary, that, this is a demand shock. But, we're at the demand. Everybody is at home buying stuff on Amazon all day. I mean, people are buying stuff, they're just not going to the stores and buying it. They're still buying stuff. And of course, people have to keep buying food. It doesn't matter whether you're employed or not. So people are spending money. The key is that we're being less productive. But all of it from the U.S. has to do with the dollar. See, this is going to be the big change, is that the dollar has been the reserve currency. Well, the dollar's days as the reserve currency are numbered. You can't have the reserve currency when the Fed says we're going to print an unlimited amount of money. When you have the government borrowing money and these massive deficits, we cannot push off the cost of financing these deficits on the rest of the world. I mean, the rest of the world also has the coronavirus. They've got their own problems. They can't pay for ours, because that's what happens. If we're running these deficits and we're not feeling the effect, it's because the rest of the world is shouldering that burden. We are exporting our debt. We're exporting our inflation. And the world is not going to want to continue this relationship. It's just not going to work. And so the dollar is going to have to be abandoned as the reserve currency. And then it crashes. And then, of course, all the imports coming into America stop coming. We don't have all these products anymore because we can't import them.
Is that the difference then? Because other currencies are in as bad a shape, if not worse. So, in my view, they should all depreciate against gold, silver, intangible assets, et cetera. But in the dollar bull story, is that because the dollar is the reserve currency and so much debt denominated in it, that there's going to be more demand for dollars, and that people are going to rush to the dollar for safety because it does have this preeminent status.
I think it's going to lose that status.
The preeminent status is basically albatross, is what you're saying.
Well, yeah, and because we've had that status for so long, that has enabled us to take on so much more debt than had some discipline been imposed on us in the foreign exchange markets. But also, because the U.S. benefits the most from the current fiat monetary system, if that system collapses because of a loss of confidence, then the U.S. loses the most. If we go back to a global gold standard, which I think we're going to do, I think central banks are going to go back to backing their currencies with gold as the primary reserve asset, which is the way it was before Bretton Woods. And I think that's the way it's going to be after. I mean, people keep saying we can't, move off the dollar because there's no currency that can replace it, the euro or the yen or, the RMB. And I would agree that none of those currencies qualify, but we don't need a currency. We just use real money. We use gold the way we used to. And so we go back to a gold standard. And the minute that happens, the biggest loser is the United States. Our economy cannot survive in its current form as a gold standard because we don't have the gold to pay all of our imports, or at least if we blow through all of our gold very quickly if we try to maintain these trade deficits, if we had to export gold to pay for all these consumer goods. And then when we ran out of gold, what would we do? So the U.S. economy has the most to lose. The dollar has the most to lose. We've got this complete phony economy. And the other problem is if you look at how popular socialism is in the United States right now, and look at how that pendulum is swinging at the time where the dollar is collapsing and inflation is running rampant, we're abandoning the only thing that can save us, which is capitalism, and kind of going all in on socialism.
Yeah, they're talking about, the universal basic income. There are a lot of people, even supposedly on the more right end of the political spectrum, and now talking about, well, yes, we should have a universal basic income. In MMT, my view on MMT, modern monetary theory, is that it's nothing new. We've been doing this since 1971, and the MMTers, as it were, they say that the only limiting factor is inflation. Well, duh, that's exactly right. It is inflation, but the point that I think you and I share, or view that you and I share, is that when you have inflation, it's too late.
Well, it's by the time you see the inflation in the government's official measures, yes, it's I would say it's like, if you're on a train track and you don't decide to get off the track until you see the actual train right in front of you, you can't, you're going to get a hit. You have to anticipate that the train's going to get there and get away. And it's almost like you're waiting for the caboose to get off the tracks when you're waiting for the government to acknowledge that inflation's a problem. And of course, the government is not supposed to wait till it's a problem. They're supposed to anticipate the problem and preempt it. Because if you wait until the inflation genie is out of the bottle, well, then you're in a lot of trouble. That's where you get these expressions that you have to be preemptive. And what the Fed is saying is, we can't be preemptive. We just rather wait until inflation is a problem, and then we'll do something about it. Well, easier said than done. How are you going to do something about it? Especially if you have inflation and recession simultaneously, like we had in the 70s, except worse.
Peter, I'm going to have to cut you off there. We've raced through the half hour. Thanks for your time. His website's
I gotta give one.
Okay,
plug,
give me a plug.
We're gonna always please.
No, because apart from Schiff Gold and buying some physical gold and silver, look, right now, I don't know when this thing is going to air, but the real value right now is in these mining stocks. I mean, in fact, a lot of the smaller stocks, even though gold is up nicely so far this year, a lot of these stocks are down pretty considerably. People are worried about liquidity.
Yeah.
They're worried about mines closing down because, the workers can't work because of coronavirus. Look, what's happening right now is so bullish for this industry as far as gold is concerned. And price of energy has collapsed. I mean, that just makes mining cheaper. Any gold that you don't mine today, you can mine it tomorrow. It's not like you can't, and it's just going to be more expensive. So a lot of businesses that have to shut down, those sales are never going to happen. But any gold sales that don't happen now are simply deferred to the future when it's going to be more profitable. Because the longer they wait to sell their gold, the more they're going to get for it. So I think it's a great opportunity to be buying these stocks. And I wanted to mention my fund, the Europe Pacific Gold Fund, managed by Adrian Day. I think we've got the best fund. We got the best manager. We got a great portfolio. So if you want to get into these stocks, especially the junior mining stocks, because those are the hardest ones to buy on your own, we got a great portfolio there. That's where the real money is going to be made. I mean, we'll make good money in the major companies. I mean, these things can still go up, but not like some of these smaller ones are going to go, and they're already down. So people should look into the Europe Pacific Gold Fund. You can get information at 𝗀𝗶𝑖𝐻funds.com. People can just go online if you want to have a small investor, you can just go right to my website, 𝗀𝗶𝑖𝐻funds.com, and just buy the gold fund. Check out the prospectus, but you can just buy it. You can call up my brokers at 𝗀𝗶𝘁 Capital and buy. We have separately managed accounts that Adrian manages with individual for larger portfolios. And my funds are available. You can get my gold fund no load at Schwab, Fidelity, E-Trade, any of these places. But I would just be getting into this sector quickly because I think there's just so much upside potential right now relative to the downside risk.
Peter, I completely agree with that. All of your analyses on the gold market, these mining companies and junior mining companies are from these levels, they're just going to go up, in my view, extraordinarily, especially the producers right away because of their costs being slashed. The price of their product is soared, and they're already making a ton of money, even at $1,500 gold, much less $1,700. And specifically, Adrian Day is a longtime friend of ours. Completely respect his expertise. He knows the sector like the back of his hand. And I really couldn't recommend him and your funds and the whole sector more highly at this point in time. So thank you for that. And
Brian, why don't you add to the New Orleans Investment Conference is going ahead at this stage. So Peter's always a speaker there, one of the more prominent speakers.
And he will be back at New Orleans, whether it's most likely going to be live. We are exploring the potential of a virtual event, but we believe it's going to be live. We're pushing forward with all the plans, and Peter will be there.
Okay, great.
That's my plan right now. But
yeah. Oh, you'll be there in some form or fashion, Peter. Don't worry.
Oh, definitely. Yeah, definitely there.
Thank you.
Thanks for your time. We have to wrap it up. Cheers.
Okay. Take care.